Our next question comes from Sean M. Sean says, "Hey, Austin and Robert, thank you for sharing your expertise with everyone through your podcast and weekly newsletter. I have a question about the chart of the week from your newsletter on June 26. You pointed out how over the past several years, July has been the best month of the year for the NASDAQ with an average return of 4%. But I couldn't help notice that September was in the red nearly every year after that for the past 16 years. Obviously, we can't predict what's going to happen in the markets, but with this data, would you recommend any action to hedge against the possibility of a September slump? And if so, what might that action look like? If you can predict a slump in the market, how would you prepare your portfolio?" I know this is speculative, and the average loss over the last 16 years is only 0.3%, which isn't much, but I guess I'm just trying to better understand what actions you each might take if you did have a strong suspicion that the market was going to be in the red. Robert, you want to kick this one off?
I would love to, Sean. I like the thought process. I like where your head's at. But the way I look at this is two-part. Number one, if you have $100 million plus and you have a team of money managers, great. You can make those adjustments and you can try to manipulate the market with these ebbs and flows of these months that mathematically generally are slower or there's a slight downturn like you mentioned. But most people that listen to this podcast do not have that kind of money. And therefore, I think what you're doing is setting yourself up, chasing pennies while dollars fly by. So in my opinion, part two of this is we don't like to see anyone try and time the market. At the end of the day, you want to get your money invested correctly. You want to have that diversification and stop worrying about the ebbs and flows of every headline, every month, and every market move. Because at the end of the day, over time, the markets go up and to the right. So for this question, I really do appreciate the process and your thoughts, but I don't think it's necessary to really dig that deep into the minutia of how you can try to time a downturn. Now, if every September the market corrected 10%, then sure, maybe there would be a philosophy or a strategy that we could make work to take advantage of that, but I don't think this is the case.
Now, let me answer that second part, which is I'm just trying to better understand what actions you each might take if you had a strong suspicion the market was going to be in the red. So as it relates to that, we had a very strong suspicion that in 2025, we would experience market volatility, right? That was a January 13 episode. It was our big market predictions for 2025. And unfortunately, we were right. So the Trump tariff tantrum that happened in April caused the NASDAQ to fall 21%. And the market's been very volatile, to say the least. So what did we do about it? We hedged our portfolios with some precious metals like gold and silver. We hedged our portfolios with QQQH and SPYH, which are the hedged equity income ETFs offered by Neos funds. And we also had Stephen Sykes on episode 120, which was published on June 2nd. And that episode was literally called How to Hedge Against Market Volatility in 2025. And in that episode, he talked about bonds that you can get on the public's bond account, paying like 7-8% right now. Obviously, you could also buy put option contracts as a way to hedge against existing holdings, covered call option contracts to collect premiums. There's a ton of different ways that we encourage people to learn more about as it relates to hedging a portfolio if you have a strong suspicion of volatility. And we followed a lot of those strategies in the first half of this year to help buoy some of the downside risks that the markets were experiencing. But at the end of the day, what Robert and I don't want you guys to do is to always be planning for a black swan event. They're called black swan events for a reason. They don't happen often. You can't see them coming, right? We want you instead to be positioned for the other 85% of the time, which is stocks go up and to the right over 1, 3, 5, 10, 15-year periods of times. And you need to have enough allocation to equities and stocks to ride that wave to the upside as well. And so, Sean, I hear you. I want to reiterate what Robert said. I love where your head's at. It's a great way to be thinking, but I don't think, in our opinion, that this is a run for the hills. Let's all try and hedge our portfolios and overthink this. But if you wanted to get some precious metals or some of these hedged equity income ETFs from Neos funds like QQQH or SPYH, knock yourself out.